In recent days, the world's largest technology firms announced massive, unified increases in their capital expenditure. The primary drivers of this accelerated spend are the heavyweights of the space: Meta, Microsoft, and Amazon. Standard economic theory dictates that when companies pour billions into capex, it signals aggressive sector expansion. Historically, this type of spending surge directly translates to massive semiconductor demand. But the market reaction broke the model. Instead of rallying on the news of increased spending, traders immediately triggered a synchronized, aggressive sell-off. The liquidation hit both sides of the transaction simultaneously. The mega-cap buyers took heavy losses, and their primary supplier, Nvidia, was immediately dragged down with them. The price action reveals that institutional capital is pricing in a severe structural reality. A complete stagnation in the physical supply chain is running directly into a rigid wall of technical resistance. To understand why this sudden reversal is happening, we have to look past the top-line spending numbers and deconstruct the capex illusion currently masking the tech sector's actual health. This flowchart illustrates the mechanical reality of recent capital expenditure. Every block of capex capital is governed by two variables: price per unit and total unit volume. The spending increases are defensive, absorbed by aggressive supply-side price hikes in chips, squeezing unit volume flat. For the megacaps, this creates severe margin compression. They are forced to deploy significantly more capital just to maintain the exact same growth trajectory they had last quarter. For the semiconductor suppliers, this creates an absolute physical bottleneck. Suppliers might report nominal record revenues due to the price hikes, but they are experiencing zero growth in the actual physical volume of chips ordered. The public sees headlines about record tech spending and assumes massive physical expansion. The grim economic reality is an absolute stagnation in actual volume. This zero-sum loop creates an unsustainable environment. With volume capped and margins compressing, the sector is stripped of the fundamental momentum required to justify further multiple expansion. When fundamental weakness enters the market, trading algorithms immediately map that vulnerability to strict macro-technical boundaries. This weekly S&P 500 candlestick chart displays an ascending parallel channel, establishing long-term resistance. Price accurately respected historical pivot points at the 2020 low, 2021 high, and 2022 low. The current index is colliding directly with the upper boundary at the 7,200 level. The situation is even more pronounced in the Nasdaq composite, which recently completed an abnormal vertical expansion to fresh all-time highs. Here on this weekly candlestick chart for the Nasdaq, we can track price against its own long-term parallel channel, tracing back to the pivot highs of 2021. Testing this historical boundary resulted in an immediate intraday rejection, wicking precisely off the structural top line. One of the most vertical rallies in market history collided directly with an immovable algorithmic wall. Institutional selling accelerated the exact moment the fundamental capex illusion met multi-year structural resistance. Zooming in on the supply chain, the semiconductor memory sector acts as a highly sensitive leading indicator for the broader ecosystem. Over the last 12 months, these specific stocks experienced parabolic 1,000% rallies. This split-screen daily candlestick chart isolates STX and WDC, highlighting localized technical exhaustion. Both tickers display textbook blow-off top patterns, defined by long topping tails on their recent candles. These tails correlate directly with anomalous high-volume spikes, confirming heavy institutional involvement. The mechanics here are clear. When massive rotational volume fails to drive price higher and instead leaves a long upper wick, it indicates peak distribution. This exhaustion in the memory sector suggests that buyers have reached maximum capacity, aligning with the broader narrative of a supply chain volume cap. This dashboard visualizes the three core pillars anchoring the current market structure: flat unit demand, firm index channel resistance, and memory sector exhaustion. The illusion of continuous growth driven by inflated capital expenditure has been identified and priced out by institutional capital. Specific structural outliers are temporarily defying the broad sector reversal, starting with Alphabet. Alphabet is demonstrating relative strength, holding technical upside potential toward the 380 level before it collides with comparable resistance constraints. Apple presents a second divergent setup, primarily because it operates largely outside the strict AI chip demand cycle constraints. This chart of Apple's price action highlights a bullish consolidation pattern, driven by internal corporate catalysts, including an impending CEO transition. Price targets sit near the 279 to 280 range, but these specific corporate setups stand in stark contrast to the broadly exhausted, heavily interconnected AI chip ecosystem. To verify the integrity of this sector top, monitor upcoming earnings in the memory space, specifically using SanDisk as the primary bellwether. The critical sequence to look for is a gap-up open directly following the earnings release, followed immediately by a downside fade as the intraday session progresses. If this gap and fade pattern appears on a major memory supplier, it completes the technical sequence of a sector-wide blow-off top. Navigating this current environment requires looking past nominal spending figures and executing strategy based strictly on underlying physical volume and structure.